So I think we'll start right in with kind of the lead-in of what the current economic situation is. I would say that certainly there's been a slowdown regionally, if not nationally. What do you think? How do you view the current state of the economy, and what's your outlook going forward for 2020?
Sure. So first of all, thanks for having me. It's great to be here. This is my first visit to Madison, and I've heard great things. I told Noah before we started that Madison alumni tend to be very loyal and very passionate about Madison, so I'm happy to be here. I'm feeling a little bit better about the economy than I was a couple months ago. I think some of the risk that we've seen nationally seems to have reduced somewhat, reflected in, you could look at it in the markets, not just the stock market, but the bond market in particular. The yield curve inverting, it had been inverted for the last 6 months or so. It's the best predictor that we have of a recession to come. The fact that it's no longer inverted, I take some comfort from that. Regionally, I also hear anecdotes of some softness. I mean, our region of the country is very exposed to the global economy. So we've got manufacturers that are exporting around the world. They're affected by tariffs, as Noah talked about. They're also just affected by end markets that seem to be growing more slowly. We know Europe is growing slowly. China is growing slowly. And so I think that this region is particularly exposed to those global developments. So I also am seeing some softness. And when I travel around and I meet with businesses, they tell me anecdotally, manufacturers talk about softness, and farmers have been under a lot of pressure for a number of years with low prices. So all of that is kind of in the mix. At the same time, other parts of the economy seem strong. Services generally continue to be strong. The U.S. consumer continues to be strong. The employment situation regionally and nationally is quite positive. Most Americans who want to work have jobs. Their wages are slowly climbing, so they have more money in their pockets, and they're spending that money on their families, either buying food or buying clothes or cars or whatnot. So as consumption is 70% of the U.S. economy. So that engine of the U.S. economy is still strong, but that tends to be backward-looking. And it's more the business investment that tends to be forward-looking. So I think it's somewhat mixed, but a little bit more optimistic than maybe it was a couple months ago.
Okay. And so you've characterized the recent Fed policy stance as neutral to modestly accommodative. Is that right, first off? And can you explain what that means, and how do we recognize a neutral interest rate?
Sure. So the concept of a neutral interest rate is something that's very important to central bankers. What interest rate neither stimulates nor restrains the economy? And the truth is, we don't know for sure. We have to try to estimate it. We cannot just directly measure it. And we've got all of our economists have different models and their wide range of estimates of what neutral could be. One proxy that I look at is I do look at the yield curve. So what is the yield curve? It is the interest rates that the U.S. government borrows from you and I. So if you buy a 1-year Treasury bond, you're making a loan to the U.S. government for a year. If you buy a 10-year bond, you're making a loan for 10 years. If you buy a 30-year bond, you're making a loan for 30 years. And typically, if you're going to tie your money up for longer periods of time, you're going to want a higher interest rate because your money's all tied up for 10 years or for 30 years. So that curve typically slopes up as you plot those interest rates over time. Well, once in a while, something goofy happens, and the plot slopes down, where people are locking their money up for a long period of time, but demanding less compensation than locking it up for a short period of time. Variety of reasons why it happens, but basically it means that investors are bearish about the future. So what does this mean with the neutral interest rate? One of the things I look at is I look at where long-term interest rates are, and I look at where short-term interest rates are and where they are relative to each other, as giving me some feedback on, is monetary policy, which is a short-term interest rate, is it tight or loose relative to those longer-term interest rates? And the fact that the yield curve is now uninverted gives me some indication that we have taken the brakes off of the economy, and we're probably providing a little bit of support. That's why I guess it's probably modestly accommodative. And I've been paying attention to my colleagues around the Federal Reserve who've been giving talks lately. It seems like there's a lot of consensus now that monetary policy is probably modestly accommodative. So I don't think I'm out on a limb. I'm out on a limb in other areas. I don't think I'm out on a limb on that one.
I meant to say at the outset that we will be taking questions from the audience, so think of them, and after we have a chat here, we'll open it up to questions from the floor.
And by the way, this is being live streamed, so this is your chance.
You'll be internet famous. So speaking of your colleagues, last month, Boston Fed president and UW PhD, Eric Rosen spoke on campus, and at that time he expressed his view, which was essentially that the economy had evolved as it expected at the beginning of the year, and he hadn't seen the need for interest rate increases. And as you know, he dissented both times. Decreases. Saw that there was no need to cut interest rates. So he dissented on both cuts this year. So why was he wrong?
Well, instead of me talking about why my colleagues are wrong, I'd rather tell you why I'm right. So why have I been opposed to the rate increases going back since as long as I've been at the Fed? When, by the way, just to be clear, my position was the same under President Obama and President Trump. So this is not about politics, this is about data. We have a dual mandate that Congress has given us. Stable prices, which we define as 2% inflation, and maximum employment. As many Americans as possible are able to work and find jobs. Typically, we think those two things are like the edges of a seesaw, and they go back and forth as the economy goes through its cycles. So how does that work? If businesses have to compete to find workers and the unemployment rate gets low, they typically have to bid up, increasing their salaries, so wages pick up, and eventually, as the job market gets tighter, businesses have to pass those costs onto their customers, and that leads to high inflation. So if the job market gets really strong, our economic theory said eventually that should lead to high inflation. And we use monetary policy to try to even these two sides of the seesaw out. Well, for the last 8 years, inflation has been below our 2% target, year after year after year. And we keep getting surprised that more and more Americans come into the labor force. There's been more slack than we appreciated. We thought that when the unemployment rate got to 4.5%, before that, we thought when it got to 5%, we'd be at maximum employment, and then inflation was around the corner. And then we revised it. Well, okay, 4.5%. Inflation's around the corner. And then we revised it. Then it's 4%. Now it's 3.6%. No inflation. So we've been missing on our inflation mandate. Inflation's been too low. And we've been missing on our labor market. There's still been slack in the labor market. You put those two things together, that means monetary policy has been too tight in this period. So I've been saying this now since I've been at the Fed for 4 years, and the data has supported this view. So I think that's pretty good evidence.
So, I mean,
But feel free to push back. I mean, you could take the other side of it.
Well, so I think if you look, so certainly historically, right? So if I look any point prior to 2007, I tell you growth's 2%, unemployment rate's 3.6%. If I asked you to guess what the Fed funds rate is, you wouldn't say 1.5 to 1.75. So why do you think, why are things different now?
Well, it's different now because of the concept that we talked about a few minutes ago, which is the neutral interest rate. What interest rate balances savings and investment in the economy? What interest rate neither stimulates nor contracts the economy? We don't set it as central bankers. We have to react to it. And almost all economists think that this neutral interest rate has fallen gradually over the last 30 or 40 years. So if the neutral interest rate has been gradually falling like this over 30 or 40 years, central bankers are moving the federal funds rate up and down around that neutral rate to try to balance the two sides of our dual mandate. So we have to react to the neutral interest rate that the economy presents to us. We don't get to set it. So what sets the neutral interest rate? It's things like demographics. We know that our society is aging. We know that we're having fewer kids than prior generations. Things like productivity, things like trade, all of these things are out there, really important macroeconomic developments, but we don't set them. We have to respond to them. And so that's why interest rates now are lower than they were 10 years ago or 20 years ago or 30 years ago. So we're modestly accommodative, and I think modestly accommodative is appropriate given the fact that we're still missing on both sides of our dual mandate.
So you mentioned, a couple times now, missing the inflation target. Do you think it was purely an instance of policy being too tight, or there seems to be a lot of uncertainty really about what's driving inflation these days, or why has it been so low kind of globally? Do you have a...
Well, we know that it has been low globally, and we know that one of the challenges is when in this neutral rate environment where interest rates on average are going to be lower, then when a recession comes, central banks have less room to cut interest rates before they hit what we call the zero lower bound or the effective lower bound. So this is true in America, it's true in Europe, it's true in Japan. So advanced economy central banks have not had as much ammunition as they would like to have had to deal with the economic reality that they've faced. So if you don't have enough room, then you would expect inflation to run a little bit below, or maybe a lot below your target on average around the world. And I think that's what we've seen.
Okay. So you alluded to some of the the difficulties in Fed policy or central bank policy making these days, and of course we saw unprecedented interventions from the central bank during the crisis, followed by the rounds of quantitative easing afterwards. I mean, do you think those tools are here to stay? There seems, at least among some quarters, to be a hope to get back to the old days where we were just working with the Fed funds rate.
Well, I think we'd all like to go back to the old days, but that would require us to get the neutral interest rate back up. So if you all want to run out and have a lot more kids, boost our population growth, or go invent some great new technology that's going to demand massive amounts of capital, then you could see the neutral interest rate go up, and then we wouldn't need to turn to quantitative easing and forward guidance. We could just go back to moving the federal funds rate up and down. So again, what is driving the low neutral rate? We think we're saving more because society is getting older and older people tend to save more and spend less. And where are the big demands for capital? The biggest demand for capital in the US economy over the last decade has been in the oil fields, in North Dakota, in Oklahoma, in Texas. A lot of capital flew in there to go after the fracking and to tap into that. It was very profitable. Where are the other big demands for capital in America today? It's not Facebook and Twitter. Those, whether those are productivity enhancing or not, set that aside. Those don't require any capital, any meaningful amount of capital. So if someone here at the university invented some great new technology, but it required trillions of dollars of investment, and you could make a good profit on that, you would see the neutral interest rate go up because there'd be a lot of demand for that investment. And then you'd have the central banks going back to the old ways of just moving the federal funds rate up and down. But given that we have this low neutral rate, at least for the foreseeable future, we have to turn to these alternative tools. Otherwise, the US economy will suffer if we just limit ourselves to the one tool.
So do you see, so certainly a number of central banks around the world have gone to negative interest rates. The Fed has been reluctant to do so. Do you see any prospects for that?
I would be reluctant to do that too. It's not something I think any of us would want to do, but I also couldn't absolutely rule it out. So I'll give you an example. Imagine if there was a recession in America and long-term treasury rates fell. Imagine a scenario where the 10-year US Treasury fell to 0% yield. I mean, I could envision this scenario if there was a bad recession. Then in that scenario, I could argue maybe we want to have a positive slope to the yield curve. And in that scenario, maybe we would want to move the federal funds rate into modestly negative territory so we had some positive slope to the yield curve for a variety of reasons. Under that scenario, I could see it, but I think before we would get there, we would probably turn to forward guidance and quantitative easing and use negative rates as a last resort, would be my guess.
So you think, I guess there's maybe a little bit of a debate about how effective forward guidance has been. You think it's been a successful policy?
Well, I think so. What does forward guidance mean? And let me go back to how do central banks affect economic activity? So we move the federal funds rate up and down. That's an overnight interest rate that banks charge each other. But you and I and businesses don't actually care about overnight interest rates. You care about what interest rate you get when you buy a car, say for 5 years, or if you're buying a house for 10 years or 20 years. You care about long-term interest rates. Well, by moving the federal funds rate up and down, that affects the expectation for the path of short-term interest rates, and that actually can affect long-term interest rates. Another way we can affect long-term interest rates is by telling you what we're going to do with short-term interest rates. So, for example, hypothetically, if we said to you, we are going to set short-term interest rates at 0 for the next 10 years, and if you believed us, there's a very good chance that 10-year interest rates would be around 0 too. So by signaling to you where the future of short-term interest rates are going to be, we can actually have a lot more influence on long-term interest rates. And the more credible our commitment, the stronger we make that promise, the more you're going to believe us, and the more there's going to be an effect on long-term rates. So I absolutely believe forward guidance can be very powerful if we use it very powerfully. And I'll give you a real-life example. In December of last year, the Federal Reserve raised interest rates and then signaled there are more interest rate hikes to come. By January, and markets freaked out. The bond market freaked out, the stock market freaked out, everybody freaked out. And by January, the chairman came out and said, you know what, we're rethinking this, and effectively signaled we're going to be on pause for a while. And then we didn't actually start cutting rates until July, 6-7 months later. In that time, you saw the US housing market rebound. We didn't change anything in terms of actual policy. We just changed what signal we were sending about the future path of policy. That is absolutely forward guidance. And that episode from December of last year to July of this year, when housing absolutely rebounded just because we changed our language, that is a demonstration that forward guidance works.
So part of forward guidance would be a communication strategy, and with the disagreement, if not dissension, we'll just say disagreement amongst the members of the committee, do you think that makes it more difficult to agree on that type of communication strategy?
I mean, sure. I think it's always easier if everybody agrees. But at the end of the day, the Fed chairman, Jerome Powell, I mean, the chairman's voice by far counts the most. And especially if the other policymakers have a divergence of views, then the chairman's opinion becomes even more important. So, yeah, there are a lot of Fed speakers. I'm one of 17. We all have our own opinions. But at the end of the day, I think the chairman gets to set the strategy, and he has tremendous support on the committee. And so I actually don't think it's difficult for the chairman to signal where we're going to go, because he's, it's not the first among equals. He's the chairman.
So at the same time, want to talk a little bit maybe as your role as a regional Fed president. How do you view that in terms of giving speeches to try to sway some of your colleagues or move the debate? And also, I mean, as we mentioned, you did dissent. I mean, do you have a threshold for how severe your disagreement has to be before you issue a formal dissent?
So one of the things that's unique about our central bank is that it is distributed around the country. So in 1913, when Congress created the Federal Reserve, they said they don't want all of the decision-making just housed in Washington, D.C. They want the regions directly involved. So the Minneapolis Fed's region is Minnesota, North and South Dakota, Montana, the Upper Peninsula, Michigan, and northwestern Wisconsin. Madison is not actually in our district, but I appreciate you inviting me here today. A big part of my job is to get to know what's happening in our regional economy and bring this information back to Washington, D.C. So at every FOMC meeting, I'm speaking in part about the national economy, but I'm also speaking about what's happening in our regional economy. And so meetings like this are really helpful to hear from you and hear from others about what's happening in our economy. So I think my job is to be, we're meant to be independent. There are 12 independent Federal Reserve banks. So I view my job as to give the best economic advice I possibly can, make the best economic call I possibly can. I don't give speeches to try to sway my colleagues. I don't think that would be effective. I think I give talks to try to explain what I'm thinking, what I'm looking at, give people a chance to react and to push back. At the end of the day, what convinces us, what sways us, I think the data is ultimately what sways us. And the data is going to be what it's going to be. And I'd rather tell you, here's the data I'm looking at, here's what I think is going to happen, here's how I'm weighing off these conflicting signals and how I'm reaching my decision, and then all of you can make a judgment of, did I make the right call or not?
Okay. So you mentioned that word independence. I would say perhaps the independence is not under threat, but maybe assault or minimal assault, not just again in the U.S., but around the world with the rising tide of populism. But I'm certain past Fed presidents didn't have to worry about what the president said on Twitter. How do you view the independence of the Fed, and more broadly, how do you view the Fed kind of as at the end of the day, is partly a political institution?
Sure. I think one of the hallmarks of the Fed that drew me to want to join it is this commitment to public service. One of the things that unites all of our employees in all 12 reserve banks, at the Board of Governors in Washington, whether you work in human resources or research, or you work in bank supervision, one thing that unites us all is a spirit of public service. So it's really woven in the DNA of the institution that we make decisions based on data and analysis, not based on political considerations. And I think both parties over time, Republican and Democrat, have really embraced that and realized that it's in the long-term interest of the country to preserve that. And so I think the institution is very strong. And the louder the political heat gets turned up, the more we all hug data and hug analysis and just realize that is our core, that's our true north, and we're not going to be dissuaded off of that. And I think that that's true with Chairman Powell, all of the members of the committee, and all the way across the staff. And I think that if the American people could see that up close and personal, I think they'd be very proud of it.
So certainly, I think Chairman Powell's done a great job of walking that line and staying true to things. But I mean, as you know, some at least former Fed officials, Bill Dudley perhaps most prominently, have expressed other views. I guess, what was your reaction? Did you read his piece, and what was your reaction?
I did.
To that?
I mean, I think one of the things that's interesting is, I guess people feel more liberated after they leave, which I guess makes sense, right? I tend to, by the way, I feel like I'm a little bit different in that I try to tell you right now what I'm really thinking. So I actually think whenever my service at the Fed concludes, I'm not going to have a bunch of stuff that I'm eager to say because I will already have said it. I was pretty shocked when Bill Dudley wrote his column saying that the Fed should engage in politics, and I don't know anybody at the Fed. I literally do not know anybody at the Fed who agreed with him.
Okay. Yeah, no, and the reaction was, I think, pretty uniform across the Fed. So.
Yeah.
So shifting gears a little bit to talk we'll come back around to some policy topics from that, but we mentioned your time in Treasury and TARP, and since the financial crisis was really kind of a defining moment for the economy, I wanted to hear just a little bit about your experience kind of being in the trenches there and what you learned perhaps from that experience and episode.
It was a terrible experience for the country, and it was a very challenging experience for all of us who were in the middle of it, kind of trying to put out the fire. The only way I can explain it is it felt like the economic equivalent of 9/11. And obviously none of the firefighters, in 9/11, the first responders died, many of them. None of us were facing actual life-threatening situations. But the stress that we felt was like, this is the economic equivalent of 9/11, where the US economy is literally collapsing around us, and we're going to be facing a Great Depression scenario. Instead of 10% unemployment, we could be facing 25% unemployment, which we saw during the Great Depression. And that was incredibly motivating and incredibly terrifying at the same time. Sitting here today, I don't think any of us in the worst moments could have dreamt that the economy would be as strong as it is right now, that the TARP would have basically gotten all paid back, the taxpayers would have made money by investing in banks, that the economy would have healed. I think this is relative to where we were, this feels like a miraculous recovery relative to then. What did I learn from it? I mean, I learned a ton. I learned that public policy really, really matters. That, I always say to people, if you want to help 1,000 people, donate to a charity. If you want to help 1 million people, or 10 million people, or 100 million people, the only way you can do that is by improving public policy. Public policy really, really matters. Either getting it wrong or getting it right. And so that's part of why I'm drawn so much into public policy, is the sense of mission and the sense of purpose. And I never want to get back there again. I mean, we never want to face a crisis like that again. That's why my colleagues and I at the Minneapolis Fed have been so outspoken about the issue of too big to fail, that the biggest banks in America are still too big to fail. If there were a crisis, taxpayers would have to step in again, and we don't think that's right. And so we should do things now to make sure that they're safe so that that doesn't happen.
Yeah, that was actually where I wanted to go with this. You probably saw that one coming. So there's been other proposals besides yours have been to try to break up the banks. If you could, again, not to criticize, but maybe talk about why your approach would be beneficial, and what would also be the costs associated with the higher capital requirements.
So our approach is the biggest banks need a lot more capital, a lot more of their own skin in the game to protect themselves and to protect all of us from losses. I'll give you just an example. So when my wife and I moved to Minnesota, we bought a house, and the bank made us put 20% down on our home loan. The more money you put down, the safer it is for the bank. If you put 50% down, the bank's got a lot of equity to cover there in case you lose your job. If you put 5% down, it's a risky loan for the bank. So the more you put down, the safer the loan. Well, banks put about half that much down, the big banks, on their own investments. They made us put 20% down. They put about half that amount down on their own investments. And yet little banks in America tend to have a lot more of their own money down. So it's the complete opposite of the way it should be. Little banks are not going to bring down the U.S. economy, and they have way more capital than the giant banks, which are systemically risky for the economy. So our analysis has said the best way to solve this is make sure banks have enough capital to cover their own losses when they make mistakes. Now, what we like about this is we're not going to get in there and tell banks how to structure their businesses. We set the capital requirements, and then banks can react to it. So there might be some business lines that it makes sense to have $1 trillion business that's highly capitalized. But there might be other businesses that don't actually have these great economies of scale, and if they face those high capital requirements, the banks would say, we're going to restructure it and shrink and spin off certain businesses. To us, this is just a much more efficient way. You set the standard and you let the market react to the standard and optimize based on those standards, instead of us coming in and saying, well, you need to restructure your bank this way, you need to restructure your bank that way. I don't think that we have the expertise to do that efficiently. So we think we would achieve the safety that we want, and it would be less costly for society.
So what's been the reaction, I guess, to your proposal?
Well, the banks don't like it, for sure, because this would directly affect their share price. So why do banks want to run lower capital? It's good for their share price. The more they can lower their capital requirements, the more it'll boost their stock price, because it's transferring risk from their shareholders to the taxpayers. That's their incentive. Unfortunately, right now the regulatory winds are blowing against us. So there's deregulation going on in Washington, D.C. right now. And what we're saying is the biggest banks need more regulation. And at the same time, we would streamline regulation for community banks because they're not actually systemically risky for the economy.
Now, that was actually one thing I wanted to touch on, because that was another piece that we'd done here in the center, was looking at, following Dodd-Frank, looking at essentially the substantial slowdown in bank creation, particularly among smaller banks. And as I'm sure you know, that's kind of the backbone of a lot of smaller, rural, poorer communities. So part of your proposal is to lessen that regulation?
It is. Part of our proposal is to streamline regulation on community banks. Now, this is a trend. Consolidation among community banks is a trend that's been going on for decades. It's just like farm consolidation. As farmers become more efficient, their number of employees goes down, small towns are getting hollowed out, it gets harder to sustain the community bank, it gets harder to sustain the community hospital, it gets harder to sustain the elementary school. I mean, all of these trends have been going on for a long time. But I do agree that I think Dodd-Frank accelerated it because it added a lot of compliance costs that's easy for a big bank to bear. It's very hard for a community bank to bear.
I do want to leave time for questions from the floor, but I wanted to end with one kind of, since we're in an academic institution, research institution, I wondered how you view the role of Fed research or economic research more broadly in your position. And for the students out here, what type of research questions do you have which they could consider?
Well, I think economic research is enormously important. The interesting thing is this topic of a neutral interest rate, this is a topic that one of my colleagues, John Williams, who's president of the New York Fed, formerly the San Francisco Fed, he and some other Fed colleagues, Thomas Laubach, among others, did research on this 20 years ago. And it's fascinating because it is front and center of all of our policy deliberations over the last few years. And they started working on it 20 plus years ago, when it was almost unthinkable back then that this was actually going to be something that we're going to care about. So that's a little bit of evidence that I can't tell you right now what you should go do research on that's going to be relevant in 10 years or 20 years or 30 years. I think maybe it's more important that you just go after problems that you find really interesting and challenging, and hopefully, your interests line up with the stars in 10 or 20 years. But research is enormously important. I think about there's so much we still don't know about the economy, about how it works, but there's also a lot that we do know that we didn't know 30 or 40 years ago. And so I think the economics community have made huge contributions to the state of our knowledge, the state of our policymaking. As imperfect as it is, we've come a long way.
So the Minneapolis Fed, of course, has I would say, rather pretty unique tradition of economic research, some of which at times seems often quite divorced from policy. I mean, is that something you've continued under your stewardship?
We have. I mean, I think we have an outstanding group of researchers at the Minneapolis Fed. And while they're free to pursue their own research agendas, they also have here at the university, you teach as well as you do your research. At the Minneapolis Fed, the deal is you can do your own research, but then you also have to support policy. So I have outstanding economists that work with me. We spend a lot of time on monetary policy, looking at what's happening in the U.S. economy, looking at the path of interest rates, et cetera. And I really benefit from having the smartest economists I can, helping me think through these issues. And they're the ones who've enabled me to take these what seemingly at the time were these wild outlier positions, saying there's still slack in the labor market, we don't need to raise interest rates. I've been able to take those positions because I had the confidence that came from debating these ideas with them before I actually went to the FOMC.
Great. So we'll take questions from the floor. There's microphones on either side of the auditorium.
Sorry, you need to get up to ask your question.
Yes. To feed into the live stream, we need the audio. So don't be shy, anyone.
Neel, could you discuss for a minute the implications of the ECB and their monetary policy and their idea of buying any bond in sight, and how that is affecting our monetary policy and the neutral rate and the implications of those things?
Sure, I think the ECB and the Bank of Japan, they are, as I talked about earlier, they're following their neutral rate down just the way we are. And our economies are not completely divorced from each other. So as you indicated, capital flows globally. So if, German bonds are at 0% yield, a 10-year bond around there, let's say hypothetically, or even negative, then relatively speaking, the US Treasury at 175 or 2 would look like a more attractive investment. And so I think all of these things are affecting all of us at the same time. So it's not the ECB, here's my point. It's not the ECB that is causing European rates to be so low. European rates are so low, and the ECB is having to follow that down because of where the neutral rate is. And a lot of these phenomena tend to be global in nature. So productivity tends to be global in nature. We invent something here, it gets adopted around the world. Inflation tends to be global in nature, and neutral rates tend to have a global flavor. They're not completely global, but there's a global component to where neutral rates are, and all the central banks are having to react to that. And again, Europe's demographics are worse than ours. Japan's demographics are even worse, so those are also having an effect. Hold on, the gentleman. Can you go to the microphone, please? I could see you shaking your head no, so you're itching to push back. That's fine.
Just to follow up on that, though, you're absolutely right. I mean, obviously, Japanese and European demographics are much worse than ours. I'd argue so are their economic policy as well. So that has, there's a lot of interplay here, but it's, taken inflation rates very low, commensurate decline in term premium around the world. But the net of it is this. You still have this wall of investment money coming from Europe and Japan and the United States. It's just a wall. If you're a life insurance company in Japan, you got to bring the money over here to meet your financial obligations. End of story. So it seems to me that is artificially depressing, our interest rates in a way that it makes it hard to understand the shape of the yield curve, whether or not it's really economics determining it or outside forces, the absolute level, what the real neutral rate is. And as you extrapolate this as we're going into the latter stage of an economic cycle, sometime in the next 3 years will be an economic downturn. And at that point, if we are, shifting to almost a zero interest rate environment here and a very flat yield curve, you have to think about the consequences of law of unintended consequences of these super low interest rates. As Warren Buffett says, when the tide goes out, you find out who's been swimming naked. You throw in what's happening with advances in financial technologies and disintermediation of the banks here in the United States with technology. There are a lot of things happening all at once that make it pretty darn hard to figure out what that neutral rate is. But I just wonder if all these factors conspire to make this neutral rate lower than it really is.
Well, okay, so there's a lot in your question. Do you think, I'm going to ask you a question in response to your question, do you think raising the federal funds rate would boost the U.S. economy?
No, and I think part of the answer to that is this. We've experienced low rates for so long now that the front end of the cyclical parts of the economy, like housing, unfortunately, in part because we've had so much home price inflation that the first-time home buyer market is kind of being
Okay, but
priced.
so you don't buy the inflation statistics? You think inflation is actually higher than 2%?
No, I think it's about 2%.
So then that means monetary policy has not been too accommodative over the last 10 years.
Right. I just worry
So,
about
but
it
no,
going
let's do
lower.
the counterfactual. If you had been in charge of monetary policy and you said, well, we're going to keep rates higher because I just believe in higher rates, then inflation would be lower and economic growth would be lower and wage growth would be lower and employment would be lower.
I'm actually okay with where we are. What my concern is, if we do go toward in the next economic downturn, and just like you said, the 10-year falls to zero, and to keep the yield curve positive, you take Fed funds to negative, and all the unintended consequences that might create.
Well, I guess my only point is we have to respond to the global economy or the U.S. economy.
Yep.
We don't. One thing I think people give us too much credit for, say the 10-year Treasury. We have much less influence on where the 10-year Treasury is than people might appreciate.
Yep.
And so we have to respond to these macro forces as opposed to getting to set all of them. And I think that's
Right.
true for Europe too.
Yep.
And so,
Well,
thank you.
it's going to be an interesting few years.
Over here.
All right, so forgive me if my question's a little bit long.
Can you come closer to the mic?
All right, yeah, so forgive me if my question's a little long. I just want to relate a few things. So you cite your recent dissents based on this slack that you claim exists in the labor market, based on missing this expected inflation that we've been looking at from 5%, 4.54, 3.6%. From what I've seen in the past, or at least my thoughts on the dual mandate, we're looking not at maximum employment, but maximum sustainable employment. And I've been seeing articles and people discussing that we're actually under, our employment rate's over sustainable, that in fact we have some unsustainable employment in the market right now. So do you perceive that the employment level we're at right now is sustainable going forward?
Absolutely. In fact, I challenge people when they say we're beyond maximum employment. To me, the only way we're beyond maximum employment is if inflation is above 2%. This idea that, too many people are working. This is bad news. Too many people are working. I just don't buy that at all. And the only way it's too many people are working is if wage growth is accelerating and inflation is now well above 2%. That to me, maximum employment literally means a labor market consistent with 2% inflation on a steady state basis.
Okay, thank you.
Sure.
So given housing costs have skyrocketed in the last 2 years, do you have any opinion on raising the jumbo loan threshold?
No, to me, that's purely the domain of the U.S. government, the executive branch, Fannie and Freddie's regulator. That's a risk for the taxpayers if they want to take it. Right now, basically, the U.S. government is taking most of the risk in the housing market, at least through Fannie and Freddie. All of the credit losses will go back to the taxpayers, and so that's purely a fiscal policy call for Congress and the executive branch to make.
All right, just one more.
Sure.
So, talking about, say, negative interest rates, do you believe, when Eric Rosengren was here just a month ago, I asked him a similar question, and he cited that one of the reasons that negative interest rates shouldn't be applied is because it conveys a weakness in the institution that sets them. So do you share that same opinion, that institutions that have employed negative interest rates, or if the Fed were to employ negative interest rates, that it would be a sign of weakness?
Yeah, I think that's a sign of weakness in the economy, as an example, because you're right. The economies that have gone negative, they've been in a very slow economic environment for a number of years. So it's not a sign of real robust, vigorous economic growth. It's the same thing. It's a debate that we have about forward guidance. So conventional wisdom is the Fed should use forward guidance once we get back to zero, and then we commit we're going to keep it at zero for a number of years. I actually think that also is a sign of weakness. It's like saying we drove our car into a ditch, and now we're choosing to stay in the ditch. All right? No, we're stuck in the ditch. That's why we're in the ditch. So to me, that's why I've been saying we should deploy forward guidance now, before we actually get back to the zero lower bound, when we actually have some control over which way the federal funds rate is going.
Thanks for your thoughts about everything. I'm not an economist, so I'm sorry if this is a dumb question.
I'm not an economist either. So that's
Okay, great. I'm not a banker. I'm not an economist. I feel humbled by everybody's information here. So I spend a lot of time with local economic development people, Adams County and Bayfield County and all these places. If this room were filled with people who are economic development directors, people in local governments who could do something basically to do, to improve their economic outlook. Because a lot of small communities just feel like, what do? We're struggling, we're tourism, and we're banking on that, but people maybe aren't, I don't know. Like, what would you tell local economic development professionals if you had everyone in the room in the state of Wisconsin to do?
Well, I'd say, first of all, it depends where you are in Wisconsin. I mean, if you're here and you have this wonderful university here, this is an incredible resource, an incredible asset that makes sure that you are taking full advantage of the brain power that's here, starting businesses, entrepreneurship, et cetera. Most communities don't have this wonderful asset here. So when I travel around the region, and especially smaller towns that are struggling, a lot of them struggle because their young people leave to go away to college, and then they want to make sure the young people come back. And so some of the towns do a better job of making it a hospitable community, so when their young people get married and have families, they want to come back and raise their families in that community. Some towns have done a good job with partnerships between the local community leaders, the elected leaders, and the local business community to make it hospitable, to make sure that there are good amenities. And then lastly, some towns have really embraced immigration as an active strategy to say that our towns are hollowing out, our young people are leaving. If we can embrace immigrants to come here, we can actually make sure that our population is growing. Not all towns want to do that. Some towns, there's frictions associated with it, but I've seen some towns in Minnesota that have been doing it for 20 years, and their towns are growing, their schools are full, their businesses have workers. There's a lot of, population growth solves a lot of problems, and a declining population creates a lot of problems. And you got to wrestle with that. You got to tackle that head on.
Nice. We are running out of time, but we will take these last two. That's good.
Hey, Neel, thanks for coming. Appreciate
Sure.
your time. Could you talk, I know the San Francisco Fed recently had a conference on climate change research. Can you talk about how you're thinking about that at the Reserve up in Minneapolis?
Sure. I'll just give you my own personal view. I consider myself a person of science. I believe in science, and if the world's best scientists tell us something's a problem, I take that very seriously. I struggle with monetary policy's role, though. We set monetary policy. We move interest rates up and down. We look over a 3 to 5 year horizon for the outlook for the U.S. economy. As much as I may believe in climate change, it's hard for me to see the U.S. climate changing enough over the next 3 to 5 years to affect my outlook for monetary policy. So, and then some people point to weather events like hurricanes are more frequent. Even when a terrible hurricane hits the U.S. economy, it's devastating for the individuals affected, but it's a mosquito bite on the context of the U.S. economy. It just never shows up in the aggregate GDP numbers because the U.S. economy is so big, even relative to a big hurricane hitting Houston or hitting New Orleans, et cetera. So even on the weather side, I struggle to see how it raises to the level of the macro GDP of the U.S. economy. So I'm interested in learning more, see what my colleagues think about it, but I struggle to see how it fits in the next 3 to 5 years.
Thank you.
Thank you for your speech. And my question is, so previously the Boston Fed president, one of the reasons he offered for his dissent for the rate cut is his concern on the corporate debt level, because he thinks currently the corporate debt level is pretty high. So I'm just wondering, what's your opinion on that issue?
Well, we have a whole division at the Board of Governors in Washington of economists that are looking out for financial stability risks. I take financial stability very, very seriously. And we look for different asset classes that seems like there's frothiness or a bubble, et cetera. And corporate debt levels are somewhat high relative to recent history. But I struggle with using monetary policy as the right solution to that. Like if we thought we saw a bubble, let's say in housing or in corporate debt, should we raise rates then? Or is that going to prick the very bubble that we're worried about? To me, the right tool for financial stability is making sure the biggest banks have enough capital so that if there is a correction in corporate debt or in housing or some other asset class, to make sure the biggest banks can withstand the losses associated with that type of a correction. I don't want to say monetary policy is never going to be useful in a financial stability context, but there are many other tools that we should use first, which are much more targeted on those asset classes than interest rates, which is going to affect the whole economy. I mean, if we wanted to slow down the corporate debt market and we raise interest rates, we'd also be increasing unemployment, we'd be lowering wage growth, we'd be lowering consumption. I mean, it would have effects over the whole economy, not just that one area that we were focused on. So it's such a blunt instrument. I think we need to be very cautious when we use it for financial stability reasons.
Okay, thank you.
Thank you.
All right, before we adjourn, I just want to mention that there is a reception afterwards. Neil will be sticking around a little bit to talk with people, and there's some light hors d'oeuvres, so please join us there. So thank you all for coming, and thank you, Neil.
Thank you. Thanks for having me. Thank you.